So now let's take a look at some common trading techniques. And each of our 4 trader types that we talked about can use one or more of these common strategies to profit. So first, we have arbitrage. And arbitrage is when a trader takes advantage of mistakes in the marketplace. When prices of a particular stock are different in 2 markets, the arbitrator buys the shares at a lower price in one market and sells them at a higher price in the other market. And since these types of price mismatches don't last long, these techniques are primarily used by day traders. Next, we have momentum trading. And this trading is done when a particular stock is exhibiting a specific trend. The trader follows the trend, placing multiple trades until the trend ceases or reverses. If the trend of the share is moving upward, the trader will buy the stock and sell it when the price is appreciated by a predetermined amount. If the stock price is falling, a momentum trader will sell the stock first, then buy it back again as the downward trend continues. This is known as shorting. Many brokers will allow you to short a stock so that you can profit from a drop in a stock's price in the same fashion you'd profit from a rise in a stock's price. So when a trader shorts a stock, they have to borrow the stock from the brokerage first. Then they sell it on the open market as if it were their own stock. If the share price drops, the trader will buy back the same number of shares on the open market at the new lower price, and then return them to the broker from whom they borrowed. The profit is the difference between the initial sale price of the stock and the cost of buying the stock back. For example, let's say we want to short a company stock and the current market price is $100. We borrow 100 shares from our broker and sell them on the open market for $100. And let's say we hold the position for a week and the price drops to $75. Now, we currently don't own any shares, so we have to buy 100 shares in order to repay our broker. So we buy 100 shares at the new market price of $75. Now, we still owe the broker 100 shares, so we fulfill that debt with the 100 shares we just bought at $75. In this example, ignoring fees, we have made $25 a share. The difference between what we received for selling the stock initially, $100, and how much we had to pay to repurchase the stock to return it to our broker, $75. Next up, we have one of the more simplistic trading techniques, which is pattern trading. Now, some traders believe stocks have definite patterns to their price movements. So pattern traders study these patterns and use them to trade when they believe a particular pattern is forming. Next up, we have scalping. And this trading technique involves making several small trades. And this type of trading only works when there is a difference between the bid and ask prices in the same market. So think of it as arbitrage, but in this instance, the trader is doing it within the same market. And the profits are very small, and the trades have to be very quick because these types of opportunities rarely last more than a couple of seconds. While this form of trading was once reserved for highly experienced traders, this type of trading is pretty much non-existent now because of all the advancements in trading technology and the growing presence of computer-generated trading. Price action trading is one of the simpler types of trading in which traders only consider stock price movements, such as the stock's open, its high, its low, and its closed within a predetermined time frame. Now, the period will vary depending on the type of trader, but whatever the trading period, the position is closed at the end of the period, even if the trader didn't make any money. A more popular technique with non-professional traders is swing trading. Now, swing traders look at the beginning of the movement of a swing in the price of a stock to initiate a position. The position gets closed when there is a definite indication that the swing is coming to an end. This is very similar to how momentum traders operate when they are looking for an up or down trend. In this case, however, the swing trader only makes 2 trades, one place to open the position and one place to close the position. In contrast, a momentum trader will follow the upward or downward movement of a stock, opening and closing multiple positions as the trend continues. Swing traders tend to have a much longer time horizon than momentum traders. In a similar fashion, range traders believe that stocks move within a cyclical pattern, but believe that they move within a given range that the traders can use to their advantage. The traders will use this range to buy at a low level and sell at a higher level, and vice versa. The trader will have studied historical price movements to identify support and resistance. So let's think back to our discussion of volatility and how we thought of it as a standard deviation. And this concept is what range trading is based upon. In our example, our mean or stock price was 5 and the standard deviation or volatility was 2. This meant that the stock price's range was between 3 and 7 based upon our standard deviation of 2. Now these two numbers, 3 and 7, make up support and resistance, so a range trader would buy when the stock price was around 3 and sell when the stock price is around 7. And finally, we have the novice's favorite, trading the news. And this is one of the more common techniques used by amateur, non-professional traders. This really isn't a technique in and of itself, but many amateur traders base their decisions solely upon news developments anyway. Normally, news developments are only a part of a complete trading plan and are used in combination with some of the other techniques we just discussed. For more on the multitude of issues trading the news, please review Module 3, where we discuss some of the challenges of trading the news.